I think people want to first understand where we are. This kind of consistent fall that we've been seeing, are we heading towards a bear market?
Tamanna, to use your own words, I think this is clearly a pause in a long bull run. India is continuing to be a great growth story. I don't think there is any doubt about that. So if you are a long-term investor, if you are okay with volatility in the interim, I think this is still a very good market. However, we should also realize that market internals have clearly changed. Most of the indices are now trading below 200-day moving average, which means that they are trading below the long-term trend lines, which shows that there is a downtrend in the market. But that doesn't mean that we are unlikely to recover. As we see a recovery in economic growth numbers, as we see slightly better earnings numbers, we should be, and with correction of valuations, we should be able to see better days for equities. However, I should also caution the investors that what we saw over the last 4.5 years, post-COVID pandemic, was clearly an unusual market. One, the entry valuations just after the COVID pandemic was very, very attractive. And also the earnings growth was really, really surprising positively all through. And the breadth of the market was also very, very strong, given that most of the businesses really did well in terms of the earnings growth. Now that seems to be changing with economic growth slowing down a bit, corporate earnings growth clearly on the back foot, and valuations having reached higher levels. So to that extent, we should not expect the same kind of one-way market, what we have seen over the last 4.5 years going forward. We should expect some amount of volatility. And also, we should moderate our expectations going forward. Most investors have seen very, very strong returns over the last 4 years on a CAGR basis. I think now we are headed for a period where you will see moderate returns with probably higher volatility.
So let me break that down. A couple of things that you said there, Harsha. First of all, you talked about valuations. What do you mean by valuations? What do we exactly mean by valuations? Let's start there.
Valuations are different from the prices. Most investors recognize where the prices are headed. However, they don't realize what valuations they are paying for that particular price. So, for example, if earnings growth is not moving in line with the valuation in the market, then obviously the risk is increasing. What we have seen over the last 4.5 years, the average price to earnings multiple of the market has moved beyond the 10-year averages, even for the large cap basket. When you look at mid and small cap basket, it's at a premium of almost like 40-50% now, even after the correction, which is a serious excess valuation, one can say. So for that to continue sustaining, you need similar kind of expectations to continue in the market, and those expectations need to get beaten almost on a successive quarter, which has not happened for the last 2 quarters. If you look at last 2 quarters, for example, Nifty earnings growth has been a very anemic 3.5-4% year-on-year growth. Whereas if you look at mid and small cap basket, by and large, most companies have delivered a negative 15 to 20% earnings growth in the previous quarter. That's where the valuations become important, which means that you have already expected a lot of improvement in the earnings as of now. However, that situation seems to be changing. And if that is changing, should you still pay the same kind of valuation, or should you be paying lower valuation? When you talk about lower valuation, that also means lower prices for the same set of stock.